Apes and apettes, welcome back to the channel. Now, I want to show you guys how I'm positioning for a possible Russia-Ukraine invasion. Now, there's a lot to know about this because I think a lot of people are expecting a major market crash off of this, and that's not going to be the case. Historically, you see the markets go down sharply off geopolitical events, and then they rebound just as fast. The Fed is going to be the big guy here. You think about this like the Fed is the wolf, and Russia is like a coyote or a small dog, right? There's very little harm that Russia and Ukraine can do to the markets compared to the Fed, but the Fed is coming up, and that's going to play a role in some of these trades that we will be going over, but mainly it's going to be about Russia-Ukraine drama. There's multiple ways to play this, and the key to this is trying to take a small amount into a large amount. It's not trying to take a large amount into an even larger amount, because you would be risking too much if the situation does not unfold like you think it will. So you can take, like we hit 2 weeks ago with the Facebook puts, $60 into $3,000 per contract. If you lose 60, you didn't blow up your portfolio and you made 3,000. That's a hell of a return. That's a wild return. But if you, traded 3,000 to Facebook call side, you might blow up your portfolio because it did not go the way that you thought it would. So keep that in mind. I'm not a financial advisor. I'm not saying to trade these exact trades or whatnot. You will probably lose your money, but nevertheless, you need to have these tools on your tool belts if you want to be successful traders and investors. Well, really just traders. You could set it and forget it, invest that way, but I think you have more potential managing your own money and playing these market moves. So let's get into this. Hit the like button for me, subscribe to the channel. Like I said, if you guys want access to all of my trades, join a great trading community. Link down below in the pinned comment. Now, the thing you need to know, like I said, Russia-Ukraine, it's not the holy grail of market catalyst. It's not the thing that is going to drive down the markets like you've seen in March. It's not this. This is not what the charts would look like if Russia invades Ukraine. Now, you might see a move to the downside, probably as low as 400 if Russia did invade Ukraine, but then you would see a sharp rebound. You would see a sharp rebound because it's not systemic. It's not something we are involved in. It's not something that's going to affect too much besides oil and rare earth minerals, materials, metals, things that Russia exports. So it's not a huge issue when it comes down to it for the American economy. We do very little business with Russia. It does not have much to do with anything. So keep that in mind. It's not going to crater the markets. The Fed could crater the markets, but in this day and age, it's more of a sell now, ask later type of mentality. So if something goes wrong, there's fear in the markets, it's sell, 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 and then we'll ask questions later. So keep that in mind. That definitely can make the pullback a little bit bigger, but I would only expect down to that $400 level. Maybe the $395 level would be like the lowest I would bet personally the markets would go if Russia did invade Ukraine. It'd probably be a 2 or 3 day drama event, and then things would recover literally by the end of the week if that happened this next week. So it's going to be very sharp. Keep that in mind. Now, the obvious trade here, and one that I have, and I don't care if you like me or hate me, I did these trades on Robinhood. They're easy to show, and I had money over there to make these trades. So unsubscribe if you guys don't want to see it. I really don't care at this point. But United States Oil Fund, that's the easy trade here. That's the no-brainer. If Russia does invade Ukraine, I would expect this thing to probably make its way back to about $85. Right, I have a $72 call expiring March 18th, 2 of them, and keep in mind what I said, a small amount into a large amount. $200 relative to my portfolio is a pretty small amount, so I'm not risking the whole portfolio, right? I really honestly don't think Russia is going to invade Ukraine. There's a lot of talks that say they will. I don't want to be one side biased here, so I want to have some exposure to that, because if Russia does invade Ukraine, oil will go up. These calls will do very well. Possibly could go to $1,000, $1,500 per contract. And if that happens at the same time, my portfolio would go down. So it's a hedge against possible downside. So that's the first trade. some of the other trades that I want to do, I have a very old debit spread here. The 150, I bought 2 of those, sold one for 145, and that would be a market downturn of about 10 to 13%. And why I like Apple right now is because Apple is holding up very well, because Apple follows the SPY, whereas when you look at the S&P 500, things don't look bad at all. I mean, the situation here looks like it's pretty damn good. We're only down to these levels we were at really in September, but look at your portfolios. Look at all the other stocks in the market besides Apple and Microsoft. They are down substantially. Even look at PayPal, down 65%, and that is not even a small company. Square, same thing there. So the markets, they're on really, really weak stilts right now. And if the markets freak out, if there is a full panic, Apple and the SPY are going to do the same exact things. But like I went over in one of the last videos, Apple Premium is much cheaper than the S&P 500. You can see the 155 strikes 8% out the money is $187. For 8% out of the money on the S&P 500, that is about $400. So the premiums are really expensive. That's why I like the debit spreads, and that's exactly what this is. You would essentially buy one and then sell one that is farther away. So that means your total cost in this is $45. That's the max you can lose, and the max gain is if Apple closed under $145 by this expiration. Obviously, the price of this will go up as the price of the stock goes down, but you won't get that max gain until Apple is under 145. This provides you guys a very cheap way to trade this. So for perspective here, if you would buy this, for $126, you could buy 3 of these debit spreads for the same price as one of these 150s, and your max gain would be $1,500. The price of Apple would have to fall to 135 to get a max gain of $1,500 on this single option. So it provides you guys a lot more leverage, in a sense of you don't have to be super far out of the money, and you can get a very nice trade out of this. So I have 2 of those. Who knows if those will hit or not. I personally like the April's a little bit more, but that's the trade I do have on Apple. And to reiterate, that is a debit spread. You pay money and then you get a max gain of the difference between the strikes. You could do, if you wanted to, I mean, you could buy a 160 and sell a 150. That would cost 164. Your max gain would be $1,000 if Apple was under 150 by the expiration. That's obvious. That's honestly not a bad trade right there when I do it like that. So I might actually make that trade, who knows, here when the market's open. But that's a debit spread, and you can actually leg into this. So let's say you bought this 160 for 290. You bought that outright, so you own that. Let's say the stock does drop. Apple goes to 160. This contract is now worth like $700 or $800. Now this 155 is worth, say, $600. You could then sell the 155 for $600, collect your money back, so you would make about $400 in profit off this trade, but then you would still have a debit spread. So if Apple closed under 155, you would make an additional $500. That is a ghetto spread, or legging into a vertical spread. It's a debit spread you're legging into. So that is a tool right now that I really like to use, because the premium is so high and the market is so volatile. If the markets bounce, these contracts are going to get clapped pretty fast. So keep that in mind. That's why I like to use the debit spreads in this kind of scenario. Another thing that I really like to do as of right now, and I have multiple of these trades that I will show you, is the butterfly. The butterfly is not a strategy that I would use in a normal market. It's not. But in this market where you're seeing a lot of, support levels that are holding up, like this 430 level and the 420 level. So I think if Russia did invade Ukraine, the markets, like I said, might go down to 400, but they would bounce back up to 420-ish, 430-ish pretty fast. People would say this is an overreaction. We're going to bounce back up. Or the markets might just fall to 420. There's not a systemic reason for the markets to continue to fall. Earnings are good. That's all the market's going to care about. Earnings are good and the Fed. Russia, Ukraine, really a sideshow. So with that in mind, 430 and 420 are the likely ranges the SPY would hold support at if we do get a lot of volatility in the markets. So essentially what a butterfly is think to yourself, by what expiration, I have the March 14th, do you think the SPY will be at? What price do you think the S&P 500 will be at by whatever expiration? In this case, March 14th. I think the SPY will be at about 430 by March 14th. I think if Putin does invade Russia, we could go to 420 and then we'll bounce right back up to 430 again, that previous support level. And I'm just going off of support levels here. So essentially what a butterfly is you would want to buy one contract, in this case the 435. You'd want to sell the one where you thought the SPY would be at, which is 430. And then you'd want to buy a contract under that. So you're protecting yourself here. And what you want is the S&P 500 to be around the contracts that you are selling. So that's where you would get the max gain. And then I kind of skip past that. The normal, it would come up $919. That's not what you're going to pay. You could go to custom, and then this would have normally said 1, and it comes up that crazy large amount. But you want to put 2 in there for the middle one, the one you're selling. And I mean, if you're in the trading community, you just screenshot me what you're doing or whatever. I'll let you know if you're doing it the right way, because you don't really want to mess this up. You could open yourself up to a decent level of risk here. But there you get, $30 is your total cost. That's the most that you could lose. Your max gain is about $500 considering your $30 you paid. It's about $470 if the SPY closed right on 430. Highly unlikely it would do that, but you have this range in between here, where if the SPY closed 433, you'd still make $120, be like 300%. And if the SPY closed at 427, you'd still make like 300%. So you have this range here, and that's what I like a lot. But if the markets crash and stay down under 425, you would lose. If the markets went back up above 435, you would also lose. So the markets have to be in between basically 425 and 435. That range in between here, that's where you profit. And that's what I really like right now, is because the fear is not going to go away, but we're also not going to see a crater into the ground. And then you just do continue, and I think I did 8 of these. So if you have 8 of these, that's $240. Max gain, if the SPY closed right at 430, would be $3,700. If it closed, in this range, you'd still make thousands of dollars. And that's really what I like about this. Like I said, not something I would do in a normal market, but when you have this kind of fear and this kind of support and overall stability, believe it or not, stability in the markets, there's not a reason for the markets to crater through the floor. I think that's where this strategy is best used, and that's really why I like that one. But I also like to set myself up in ranges with this. So I'm betting the SPY will be at 430 by March 14th. That's 2 days before the Fed meeting. So keep that in mind, because I think there will be fear, and that will keep the markets down heading into the Fed meeting. But I don't think you're going to see a full-on, mass liquidation down to 300s, for the SPY. I don't think that's the case. But then again, you never know. So then, my personal opinion, I want to go a little bit further out. So in case I'm wrong on that, I can be right on, something else. And I got the April 14th as well. And what I got going on here is I think the SPY will be around 420 by April 14th. And the key with this as well, I should point out, is that you don't make as much money if the SPY goes right down. Like I said in the last example, the SPY is at $432. I make the most money if the SPY closes at 430. So if the SPY were to hang around this range, go up, go down, but stay around 430, you would start to see more profits every single day start to rack up quickly. So that's where you make the money, is really during slow declines in the market. or if it goes down fast and just stays down for a while. That's where you make the money. So I did that. I bought a 425, sold a 420, and bought a 415. Did the whole thing, go to from normal to click that arrow, go to custom, and then put 2 for this one you're selling. It'll always be the middle contract right there. And that comes up. Okay, did not do that right. Don't listen to me. Hold on. Did it not put in 2? Okay, there we go. 2. Now it says $18 is your total cost. Max gain $482. That is if the SPY closes at 420 by your expiration. I have 10 of these. So you go in, put 10. That's $180 max loss, maximum amount of money you can lose. And your max profit is about $5,000. Even if it's in that range, like I said, you'll still make a lot of money. Even if the SPY closed at $416 by April 14th, you would still make $1,100. So to put that into perspective, it's very, very nice. So you get this range. In my cases, I like to do that $10 range, and that's where you make money. And I think that's one of the best strategies you guys can really do right now, to put a small amount in and to potentially make a lot of money. And that's the key here. You don't want to YOLO everything. You want to take a small amount into a large amount of money. So I really like the USOs. I really like these butterflies as of right now. Other ways you could trade this is going to be the UVXY. That's basically the fear gauge. But it's also, it's something that is a little bit different. So I actually do have some debit spreads right here where I legged into. It says total return 753%. So essentially what this is I bought a UVXY for $266. The UVXY went up. I sold one for $274. That was a $20 call. So I bought an 18, sold a 20, collected profits by doing this. Now my max gain is $200 between 18 and $20 if UVXY closes above 20 by March 18th. So I'm utilizing this debit spread. I'm quick to get my initial investment back and hold out that spread to potentially make more money. And I know I'm unloading a lot on you guys pretty quickly here, but I think that's the best way to do it. You guys can just rewind the video so you can go back and look at these things yourself. There's also the SPXX. So you could use this one as well. This is the daily S&P 500 bear 3 times leveraged index, and it's basically the same thing. If you pull this up, it goes up when there's fear in the market. So you're coming to this point. It might go crazy, UVXY, everything might come crashing down. But this is also another one you don't want to put a ton of money in because it's designed to go down. So a small amount can make you a very large amount. For an example, if you had put $100 into the UVXY, which I did, before the crash of 2020, put $100 in, that would have turned into $10,000 per contract, per $100. So a small amount can go a very long way if you are correct and you do catch one of these moves to the downside. So hopefully that did provide you guys some clarity. You can also go with some of the gold miners. I do have a couple trades on GOLD, Barrick Gold right here. And I do have $25 March 18th, 3 contracts, average cost of about $35. These contracts were actually up a lot more. They were as high as $46 Thursday, but gold went down just a little bit today. It rebounded that plus some in after hours, so they should do well. Definitely if Russia invades Ukraine, it's going to do very well. But nevertheless, those are ways that you guys can hedge out your portfolios. If your portfolios are going to go down, you could take a small amount of money and try to make a large amount. Certainly if you can play these strategies correctly. My favorites right now, definitely going to be the USO calls as well as the butterflies, but the butterflies probably going to take the cake because this range that we do have support on the SPY at 420, 430. So thank you guys for watching. If you guys found value out of this video, hopefully you learned something. Let me know in the comment section what you want more clarity on or what you have questions on. Let me know down there and I will clear that up for you. Like the video, subscribe to the channel, all of that good stuff. Like I said, link for the trading community down below in the pinned comment, as well as the links to get yourself some free stock with Moomoo, Weeble, and Public. Thank you guys for watching, and I will see you in the next one.